So thank you again for joining us today. Just a quick disclosure, we'll be talking about performance at a few points in times throughout this morning. So just a quick reminder that past performance is not a guarantee of future results. On our agenda today, we want to thank Doug Longo for joining us from Dimensional Fund Advisors. Doug's going to join us today right off the bat to review the DFA investment grade bond fund. After that, after Doug's presentation, we're going to take a little quick 2020 year in review and talk about some of the important things that happened in 2020. We'll cover some key learnings from 2020, including GameStop, and talk a little bit of a lesson in I'm just checking my mic here. I'm going to unmute this. I've got some people saying they can't hear anything. Can somebody just reply back to me in the chat box and let me know if they can hear? I think we might just have one person that's having an issue. Yeah, it looks like everybody's okay. So it looks like we've got one person that maybe has an issue. So apologies, but we'll get back on track here. So we'll talk about some new political changes and our view on politics. And Rachel's going to give us an update on the new client portal, some things that you might expect coming up on the new client portal. And then finally, we'll finish off with a quick update on the Schwab acquisition of TD Ameritrade. But first, let's start off with Doug. 2020 was a year that bonds played a key role in our portfolios. While they received no press, and you would almost never have heard about them on the news or the internet, bonds played a critical role in allowing us to both moderate volatility and rebalance portfolios at the height of the stock market panic in March of 2020. In addition, our largest bond fund holding, the Dimensional Fund Advisors Investment Grade Bond Fund, which you'll notice as ticker symbol DFAPX in your statements or online, continued its run of exceptional performance last year versus its benchmark index. Bonds are often thought of as the boring, conservative cousin to equities, but they can be incredibly complex to manage. So we thought we'd ask one of DFA's portfolio strategists to join us today to share with you a bit more about how dynamic and interesting the management of the investment grade bond fund actually is. So just a little bit of a quick background as I introduce Doug. Doug is the head of Dimensional Fund Advisors fixed income portfolio strategists. Doug leads a team dedicated to supporting the effective communication of Dimensional's fixed income investment approach and strategies to clients and prospective clients. Doug's a frequent writer on fixed income topics and a frequent speaker at industry conferences and seminars. He began his career as an associate at Bear Stearns and then moved on to Merrill Lynch, where over time he's gained experience trading and managing fixed income portfolios in corporate, municipal, mortgage-backed, and government debt. So Doug's got a really broad background today. You're going to be able to ask him questions across the fixed income spectrum. Prior to working in finance, Doug was one of the youngest sergeants in the history of the United States Marine Corps. As a Marine, he was awarded a Navy and Marine Corps Achievement Medal for leading his platoon on multiple operations in the Middle East. So for that, Doug, on behalf of everyone on this webinar today, we thank you for your service. So having said that, the reason we've asked Doug to join us today is Doug does a great job of explaining the complexities of the bond market in an easily digestible way. So with that, Doug, we'll transition to you. We'll stop sharing our screen and we'll fire you up here. Give me just 1 second, Doug. Hold on, where is Doug in here?
Can you go to his video up there?
Doug, I think you're unmuted and
good.
ready to go.
All right. Well, thank you, Mike, and thank you everyone for your time today. I have about 15 minutes worth of prepared remarks, and then we're going to leave 5 minutes for Q&A. If we go longer, that's perfectly fine with me. As Mike said, I'm the senior or head of the fixed income portfolio strategist at Dimensional. I'm going to speak a little bit about our philosophy, how we implement portfolios, specifically the investment grade portfolio, and then really what happened in 2020. When we look at Dimensional, we're a large institutional asset manager, so we have many years of experience. We've been managing bonds since 1983. We founded the firm in 1981. We manage about $115 billion worth of bonds in many different types of strategies all around the world. So lots of experience implementing portfolios. The investment grade portfolio we launched in 2011, so it's coming up on a 10-year history. That portfolio invests in government bonds and corporate bonds, and they're investment grade only, so the higher quality corporate bonds, so AAA all the way down to BBB. You can think about that portfolio as being something like a core bond portfolio, where it's a larger holding of your fixed income. It's a representation of really what the U.S. fixed income market would look like. I'm going to walk through our philosophy in terms of how we believe prices reflect information. We believe at Dimensional that investors all around the world are consuming publicly available information about stocks and bonds, and they use that information to buy and sell. So they'll create an opinion. They may say, well, I think yields are going to go higher, so I want to sell a bond. And for everyone selling a bond, there has to be someone on the other side of that trade actually buying a bond. So their opinion might be yields are going to go lower. And we would argue that there's really no reliable way to forecast which way yields are going to go in the future. But we know that prices right now reflect the aggregate opinions of the different market participants. Someone's selling, someone's buying, and that price now reflects both of their opinions. And we can use information in that price really to position the investment grade portfolio to outperform the market. And I'll speak about that. We could also use information in bond prices to give every single bond a dimensional credit rating in addition to Standard & Poor's and Moody's credit rating. So we manage default risk in portfolios. And then from there, how we implement is very, very important, which I'll kind of get into in a very thoughtful, meaningful way to turn over bonds into portfolios. I'm going to start with the most simplest illustration, and that's a yield curve. Not to insult anyone, there are many different types of folks on the webinar, so I want to start really at ground zero with bonds. And the yield curve is just giving me what the yield is for bonds of all different maturities. So some bonds may have a maturity that's 30 years, meaning someone's lending money to an issuer for 30 years, and they receive an interest rate over every year for that 30-year period. What a yield curve does is it just takes all of the bonds of different maturities and then plots a line through all of their different yields. And intuitively, you would find that bonds with longer maturities have higher yields because you're lending someone money for a longer period of time, and you would require a higher interest rate to do that. We call it a normal yield curve environment. We find, again, there's no way to outguess yields. We don't believe there's a way to forecast what yields are going to be next year or the year after. The year 2020 was a great example. I did an interview with Bloomberg in January of 2020, and there were a bunch of folks on that from other firms who were in the business of forecasting interest rates, and they all forecasted higher interest rates for the year 2020. And as we know, interest rates decreased pretty significantly last year. So we don't believe you can forecast interest rates, but you can use information in bond prices to outperform the market. As I was saying, when you have an upwardly sloped yield curve, longer term bonds generally have higher yields than shorter term bonds. And that gives me a lot of information about bonds that you buy and hold to maturity. You get the yield to maturity of bonds. In some cases, you may actually get a better return from a bond by buying it and then selling it before it matures. And we can calculate what the expected return of that bond is by using current bond prices. And I promise this is the most mathiest slide I have today. But for example, when we're managing the investment grade portfolio, the way we decide which maturity bonds we want to buy is by going across the yield curve, looking at the yields of the bonds that are in the market right now, and then using those to calculate the returns. For instance, if I want to know if I buy a 5-year bond right now, so 5 years to maturity, what do I expect to return on that bond if I buy it and sell it 1 year from now when it's a 4-year bond? Well, I don't have to predict what the price of that bond is going to be 1 year from now when it's a 4-year bond. I can use the current prices that are in the market right now. So for example, that 5-year bond has a yield. And I understand that if I hold that bond for the next year and that bond doesn't default, I'm going to actually receive that yield. So that's one component of the bond's return. And then to get a proxy for what the price of the bond will be in a year from now, we can actually use the current price of a 4-year bond today to tell me what the expected capital gain of that 5-year bond would be for the next 1-year period. And that's the second component of a bond's return. So in addition to the yield on an upwardly sloped yield curve, as that bond's yield decreases, as it moves to becoming a 4-year bond, when its yield decreases, its price is going to increase, and the price of a 4-year bond would give me a capital gain. So together, these are what we call a forward rate. You don't need to know any of this. The idea is that you understand that dimensional in our portfolios, we're being very thoughtful and rules-based, looking across the yield curve and calculating these forward rates based on current bond prices, not trying to forecast the future market. So in the investment grade portfolio, we'll actually go across the yield curve and calculate these forward rates or expected returns in very, very small windows. So maybe this is a 1-year period example. I'll do it for a 3-month period, a 6-month period. And then every time we execute a trade in the investment grade portfolio, we want to move to the area of the yield curve where we can maximize this combination of yield and what we call roll on the yield curve. So price appreciation as that 5-year bond becomes a 4-year bond and its yield is decreasing. So again, it's a very systematic rules-based approach. And what does that mean for the portfolio in terms of how we look different relative to either a benchmark or an ETF? Well, when you have a steep yield curve, longer-term bonds have higher yields than shorter-term bonds. The portfolio's duration might look longer, weighted average duration of all the bonds or weighted average maturity, than the index or an ETF that tracks the index. In the investment grade portfolio, we look at the average duration of the US aggregate bond index. And when yield curves are steep or long-term bonds have higher yields than short-term bonds, we're willing to be a little bit longer or a quarter of a year longer than the US aggregate bond index in duration. So we're willing to do that because of the expected returns are higher when the yield curve is steeper for longer-term bonds. If you have a flat or inverted yield curve, now what we have is bonds that have shorter maturities, but actually have higher yields than longer-term bonds. We call that an inverted yield curve. It's not intuitive to a lot of folks. Why would I get less yield for lending someone money for a longer period of time? Well, it actually winds up happening in the bond markets. It happened recently in the 0 to 5-year segment of the yield curve in the US and global developed markets. And when you think about bonds, it doesn't make sense to me to buy a 5-year bond when I could buy a 3-month bond or a 1-year bond that gives me a higher yield than the 5-month bond, and I get the money back in a shorter time period. So in the investment grade portfolio, if we have a yield curve that's flat or inverted, we'll start to buy bonds that have shorter maturities. And that means we have less what we call term risk, less volatility. And then the duration of the portfolio will start to look shorter than the duration of the benchmark or the index, or shorter than the duration of an ETF that tracks a benchmark. So in the portfolios, we're being very dynamic in terms of where we're investing across the yield curve based on information in those forward rates or the shape of the yield curve, not forecasting future interest rates. And here's just a little bit of the research, and I'll explain what this slide means. I can actually look at bonds through time, going back to 1976, and I could look at bonds with longer maturities compared to bonds with shorter maturities. And I can take the yield of the longer term bonds and subtract the yield of the shorter term bonds from them. And that difference is what we call a term spread. So anytime a term spread is large, more above the x-axis, that means the yield on long-term bonds was a lot more than the yield on short-term bonds, so a normal yield curve. Anytime this yellow line gets closer to zero, it means we have a flat yield curve. Anytime this line goes below zero, it means we have an inverted yield curve. So the yield on long-term bonds is actually less than the yield on short-term bonds. Well, what we're showing here is that I can actually see that there is information in the magnitude of that difference in yield between long-term bonds relative to short-term bonds. When long-term bonds have more yield than short-term bonds, so at least 0.5% more than short-term bonds, their average monthly return relative to short-term bonds becomes larger. So this 0.15 is the extra return you got in longer-term bonds relative to short-term bonds when the yields for them were at least 0.5% more. When their yields were only 2.5% or more, the extra return you got in long-term bonds relative to short-term bonds was almost half of the steep yield curve environment. So what am I saying? What I'm saying is that when yield curves are steeper or the yields on long-term bonds relative to short-term bonds is more, you should look to buy more long-term bonds. When the yield curve becomes flatter inverted, the research is showing us that that difference in return becomes smaller between long-term bonds and short-term bonds. So I don't need to forecast future interest rates or inflation or what the yield curve is going to do. I can look at that shape of the curve, and that could guide me in terms of where I want to buy bonds for the investment grade portfolio. It's a very systematic way of managing. Same thing with credit spreads. So a credit spread is the additional yield you get for buying a corporate bond relative to a government bond. So corporations, they issue bonds just like the government, and they generally have higher yields than government bonds because they tend to have a higher probability that you may not get paid back. The US government, they're almost always going to pay back their bonds. So we call US government bonds really the risk-free rate. You're certain to get your money back. In corporate bonds, there's a little less certainty. We call that corporate risk or credit risk. And what we wind up doing at Dimensional is we look at the difference in yields between corporate bonds and government bonds. And when that difference is large, we want to invest more in corporate bonds. I'm getting more yield for taking that additional credit risk in the portfolio. In periods where the yields on corporate bonds relative to government bonds are more similar, well, we don't want to hold as many corporate bonds. It doesn't make sense. We should focus more on government bonds in the portfolio because I'm not getting additional yield to take that credit risk. And what I'm plotting here is that difference in yield through time between government bonds and corporate bonds. Anytime this yellow line increases, it means I'm getting more yield in corporate bonds relative to government bonds. And then we can look to see, well, what happens for the return of corporate bonds relative to government bonds when that yield difference is larger. And that's what I'm showing here. So this is saying that in periods where corporate bonds at least yield 100 basis points or 1% more than government bonds, they on average return about 15 basis points more than government bonds per month. If I look at periods where the yield on corporate bonds was only 0.5% higher than the yield on government bonds, their return was less. It was 0.1% more per month. So again, another way of saying this is that if you look at the yields on corporate bonds, as they become larger relative to government bonds, you actually want to start to buy corporate bonds in the portfolio. And that's what we're going to do in the investment grade portfolio is look at the magnitude of those credit spreads. And that's what I'll walk through right now using last year as an example. In the portfolio, we're going to look at the credit spread between government bonds and corporate bonds. When that difference is larger, we'll focus more on corporate bonds. And then we're going to look at the yield spread between different credit ratings of corporate bonds. So every single corporate bond gets a rating, just like an individual gets a credit rating. Well, so do corporate bond issuers. And if they have a rating of AAA, it means they're the highest quality. They have a very low probability that they're going to default. If a corporate bond issuer has a rating of BBB, they still are high quality, but they're not as high quality as maybe an 800 credit score. So what we're going to do at Dimensional is we're actually also going to look at the yield difference between the different credit ratings. And as the lower ratings, your single A and triple B rated bonds, as they start to get higher yields relative to the higher rated bonds, we'll start to focus more on single A, triple B rated bonds. If the yield you get from single A, triple B rated corporate bonds relative to your higher rated triple A, double A bonds becomes smaller, we'll focus more on higher quality bonds in the portfolio. Very similar to how we look at information between government bonds and corporate bonds. Within corporate bonds, we look at the yields for the different credit qualities, and that enables us to focus on the different ratings depending on the yield difference. So how did we do in 2020 in terms of moving? Well, I'll show you in the aggregate. If we look at the year 2020, coming into the year, these are what we call credit spreads. The yield difference between corporate bonds and government bonds was very, very small. The yellow line is the long-term median of the difference in yields, and we were below that. So in the investment grade portfolio, we wanted to focus more on government bonds and reduce our exposure to single A, triple B rated corporate bonds at the beginning of 2020. And then we all know what happened in March is credit spreads widened. So the yields on corporate bonds became significantly more than the yield on government bonds. What does that mean for the investment grade portfolio? It means that we want to start to now buy corporate bonds because you're getting a higher expected return to take that credit risk. And I'll give you an example. If I look in the investment grade portfolio on the last day of 2019, so December 31st, 2019, and I added up the weight of the portfolio in all single A, triple B rated corporate bonds, we started at 46% of the portfolio is in corporate bonds rated single A, triple B. And then as these credit spreads started to widen, we were starting to buy more single A, triple B bonds, and we got that weight up to as high as 51% of the portfolio. So we don't want to go to 100%. We still want to have more weight when credit spreads are wide, but we had the ability to do that because of that rules-based approach looking at the magnitude of credit spreads. So we went from 46% to 51% by the end of the third quarter last year. And then what happened in credit spreads throughout the end of the year, credit spreads narrowed again. So we came back from a scenario where everyone was working from home. We got some news about a vaccine. GDP started to increase a little bit. There was a little bit more certainty into the market. And the yield difference between corporate bonds and government bonds started to decrease. And then what did we do in the investment grade portfolio? Well, we sold some of those single A, triple B corporate bonds after we captured all of their returns, and then now start to move the portfolio back to higher quality corporate bonds and into government bonds. So a very, very systematic rules-based approach as opposed to trying to guess what the markets are going to do in the future. One of the things we do, and I'm getting close to the end of my comments, is for every bond that we buy, we give it a dimensional credit rating in addition to the rating agency's credit rating. So think about an individual, you get a credit score from the big credit rating agencies. Well, we don't think that's good enough. We actually want to give everyone our own credit score as well. So what does that mean? It means that for every bond that's single A and triple B rated, we're going to actually go through the market and look at, well, what's the yield on that bond relative to bonds of all different credit ratings? And sometimes what you wind up seeing is a bond may have a higher credit rating, so single A, but it actually behaves and trades in the bond markets like a triple B rated bond, like a lower quality. So somebody may have an 800 credit rating, but they're actually behaving like someone that's a 600 credit rating in the short term, and their rating agencies just haven't caught up yet. Well, we actually wind up seeing in the markets, those bonds start to trade like lower credit quality because the agencies are usually 2 to 3 months behind in downgrading bonds. And when we look at the bond market, what I'm showing on the left is that for triple B rated bonds, on any given day, about 10% of the market trades like high yield or junk bonds. And those aren't the bonds we want in the portfolio. We want bonds that trade like investment grade bonds. So in the investment grade portfolio, we're not going to say, well, I can get more yield for buying a bond that's trading like high yield, but has an investment grade BBB rating. We say, no, it gets thrown out of my list as a candidate to buy in the portfolio. And really what that means is that we really believe that prices reflect all available information. They're very, very quick in incorporating all the different views of the market participants. Again, I get questions every day about interest rates are going to go higher. Well, for everyone who thinks that and is selling a bond, someone's on the other side buying that bond. And that's why we say prices reflect that aggregate wisdom. And then we could also use information in that price to go out and give each bond a dimensional credit rating. And then having an opportunity set that enables us to diversify. In the investment grade portfolio, we put very strong caps on the individual issuers in the portfolio. So we're very diversified across many different names, and caps on things like overall credit quality in the portfolio and duration. And then that implementation piece where we're not going to just go out and buy bonds because they have a credit rating of single A, BBB. We want to make sure that those bonds actually indeed trade in the market like investment grade bonds should. The last thing I'm going to do is just kind of end on what the experience looked like by sharing one last screen, and then we'll have a Q&A. So this is the investment grade portfolio, what we call a fact sheet. And this is showing the performance of the portfolio as of the end of last year, and then how we did relative to our benchmark. For the 1 year performance last year, we returned net of all the dimensional fees, 9.2%, where our benchmark returned 7.5. So very, very good performance. A lot of folks are surprised that you can get 9% in a portfolio in a low interest rate environment. And then when we look historically, very, very good outperformance relative to our benchmark, all by using those forward rates and credit spreads. So I'm going to stop right there and then turn it right back to Mike to see if we have any questions.
Doug, we definitely do, some good ones, in fact. But real quickly, could you go back to your presentation, because there is one question around implementation. Could you spend just one second on the slide that I think right before that on trading costs and
Sure.
the relative price advantage for flexible trading? Got a couple of questions that I think this will answer.
Perfect. Yeah, I wanted to skip it for the time, but it's a great slide to cover. So let me explain what I'm showing here. Is in the U.S., anytime someone trades a bond, they have to trade through what we call a broker-dealer. And that means that every trade has a broker-dealer on one side of it. And broker-dealers are required to report all of their trades to FINRA and the SEC. They have to report, what bond they traded, the price. And what that means is we can actually look in that database and identify every single bond that Dimensional traded in the market, and then look at how did we execute relative to someone who traded the same exact bond right before us and right after us. Did we get a better price than they did? Because it's all in that database. And that's what we're illustrating. So if we look in 2019 on the left, if you think about Dimensional as being this little blue block, on the far left, what this is saying is that on average, when we bought bonds, we bought them 32 basis points cheaper than someone who bought the same exact bond right before us. I can actually control for that. I can tell our trader that you can look in the database and do not buy a bond unless you get a price 32 basis points better than the last trade in that bond. We can control that. What we can't control is what happens after we trade a bond. And what this is showing is that when we trade bonds, on average, we get prices 27 basis points better than someone who bought the same exact bond right after us. Same thing with the sells. When we sell bonds, we sell them for about 6 basis points richer or higher price relative to someone who sells the same exact bond right after us. We can't control for that at all. They can actually see where we traded bonds and they get worse prices than we did. And then when you compare that to the first half of 2020, where there was all this volatility in the market and everyone said there was low liquidity, we actually wound up performing much more better relative to our peers. We bought the bond 37 basis points cheaper than someone buying the same exact bond right before us. And we sold them actually 51 basis points more richer or higher prices than someone who sold the bond right after us. And this goes all back to our philosophy where we think markets incorporate a lot of information. We can look at bonds as being substitutes for each other. We focus on their characteristics, and we can walk away from trades. Whereas an ETF that is, let's not to pick on Vanguard, but it's just a fact of their business. They run a lot of ETFs that are benchmarked to an index, and they have to track that index. And when bonds are falling out of that index or being put in that index, they have to buy and sell those bonds immediately. They have a demand for them, whereas we're very price sensitive. We argue, well, if you want to buy a particular bond because it's getting put in an index or taken out of an index, we'll sell you that bond or buy that bond from you, but we're going to take a majority of the price from you for doing that. So this is all within how we manage portfolios and set them up to be very flexible in trading.
Thank you, Doug. A second question here is along the lines of sort of the both the credit and the term spreads that you talked about. The question is, how frequently are you looking at these spreads?
So we're literally looking at these spreads every single day, continuously throughout the day. So we have charts on our screens that are showing us what credit spreads are doing. And what that doesn't mean, though, is that we're actually selling a lot of bonds every day and buying new bonds. Credit spreads and term spreads, they generally move over longer periods of time. And one way to think about it is usually when we buy a bond in the investment grade portfolio, it typically lives in there for at least a year before we turn it over. So that's a really good frame to think about. But every day we're managing the portfolio, but we're being very, very flexible on how we trade. We're not going out and demanding immediacy in the market.
Great. Just a reminder to folks, if you want to ask a question, just go to the chat box in the software and feel free to send us a question over at any point in time today. Doug, one other question came through, and it's a question around rising interest rates. The question was, they've noticed that we've seen slightly negative performance on bonds so far this year due to the rising interest rates. What might investors expect in the future with respect to coming off of what would have been all-time lows in interest rates?
Yes, so let me answer that a couple of different ways. All-time lows. In the US, we do have all-time lows in terms of interest rates. But when I speak to some of our clients in the Eurozone or in Asia, they say we have very high interest rates relative to their local markets. So it's all relative. At an absolute level, we have low rates. Relative to the rest of the world, they think we have high interest rates. So what am I saying? That there's no reason why we would think that interest rates have to go very high in a short time period from where we're at in fixed income. We also don't believe there's any way to forecast that, using my example in early 2020 in my interview, where a lot of folks that were our competitors were forecasting higher interest rates for 2020. So what do you do if you can't forecast rates? Well, you can use information in the shape of that yield curve. And we find through time, the shape of the yield curve is just about as important as the level of interest rates. So you want to move the duration longer, buy longer bonds when it's steep, and trade that off and buy shorter term bonds when the yield curve is flat. And that's what we're going to do in the investment grade portfolio is move based on the shape. And then we understand that there's going to be some volatility in there, but it all comes back to what's the goal of that portfolio and your overall asset allocation. And generally it's to provide some stability when equities have a sell-off, right? You want the bonds to appreciate as equities depreciate, and then you rebalance back into equities and out of fixed income. So it's the correlations between asset classes in addition to the steepness of yield curves that's very important to us.
Doug, last question here, and then we'll let you get on to managing portfolios. Can you speak to fixed income investing in a secular rising rate environment?
Yes. So I'll give you an example. When we did the research to launch our first portfolio in 1983, that research was done by Professor Eugene Fama, who's a member of our firm. He's a Nobel laureate. and professor at the University of Chicago. And he did all of this research on using these prices that I was describing earlier, these fill rates, using a data sample from the 1950s to the late 70s. And if anyone remembers, from the 50s to the late 70s, interest rates were going straight up in the air, mostly due to inflation. And what he found is that it wasn't the path of rates higher, it was, again, the shape of the yield curve that was the most important thing. And he found that even in a rising rate environment, if a yield curve is steep, when you extend your portfolio out longer, that yield on the yield curve and that roll on the yield curve can offset some of the increases in interest rates. So that's what we call the out of sample proof that you can do it in a rising rate environment. And then Dimensional's founding in 83 and managing bonds from 83 to 2021 is the live sample of data that shows that you can even do it in a falling rate environment.
Super, Doug. Well, listen, thank you very much. We greatly appreciate you taking a little time out of your day today to join us and share your thoughts. With that, we will let you get back to managing portfolios, and thank you and the team for not only a great 2020, but as people saw, you know, the investment grade bond fund is our single largest holding at Aspen Capital Management. The performance has been exceptional from the beginning, and for that we thank you.
Thank you, Mike, and thank you everyone for trusting us with your assets. We appreciate it. Have a good day.
Thanks, Doug.
Yep.
Okay, I'll get back to sharing here. Appreciate you guys sitting through that. I hope everyone felt like they were able to take something away from that and just learn a little bit more about the intricacies of managing the fund. The discussion there was great with the questions. We took a little bit longer than we thought we would, so we're going to move pretty quickly through some of the other things here on our agenda. If we go through anything a little quicker than you might have liked, please do feel free to reach out to us, and we'll follow up with any questions you've got. Just a quick update on our team today. Bryn on the far right is on vacation today, but you're going to hear from the four of us, myself, Katie, and Joanna on the advisor team, and then Rachel's going to join us later in the discussion today from the operations side to talk for a little bit about our new client vault that we rolled out here in the last couple of months.
Okay, thanks, Mike. Hello, everyone. It's so great to be with you all today. I'm going to do a quick review of the unbelievable year of 2020 and the epic events we endured together. We saw a deadly pandemic, a global movement for racial injustice, a presidential election, the fastest recession in history, and the fastest recovery in history, all in 1 year. So what you're looking at here is a very busy slide. This graph is listing major events in 2020 relative to the S&P 500 performance. The blue line here represents the cumulative total return of the S&P 500 for 2020. As we walk through the next few slides, I'll highlight a few major events, mostly in the first part of the year, so you can see what was taking place in the world and how those events correlated with the market. Let your eye follow the red circle as I progress. January, the US announces its first COVID case and our wild ride starts. February, and unemployment hits its lowest in 50 years, but markets don't care and equities start their decline. By March 23rd, the S&P 500 hits its low for the year, with some equities being off their highs more than 40%. Fast forward to April, the world is in lockdown, GDP falls to 4.8%, and unemployment hits 14.7%, the highest since the Great Depression. And yet, in spite of all that is happening in the US market, the market is resilient, and the S&P 500 returns to its January 1st values by mid-May. The market continues its instability as COVID cases ebb and flow through summer, and we move into election season. By the end of the year, a vaccine is approved, a new president is confirmed, and the S&P 500 finishes the year up over 16%. Wow, incredible. Markets are truly resilient, and last year was an extraordinary example of just how true that is. Now that we've been reminded of the events that took place in relation to the S&P 500, let's take a look at the performance of the different asset classes in your portfolio. So here you're looking at a market summary. You can see the performance by asset class. US stock market was up over 20%, close to 21%. International developed stocks were up over 7.5%. Emerging market stocks up over 18% last year. Global real estate finished the year down just over 9%. And the US bond market finished the year up around 7.5%. Who would have thought after everything that happened and all that we went through, last year would have ended the year with only one asset class negative and double-digit returns in some asset classes? Just incredible. So in addition to those great returns, we also wanted to highlight quickly, again, how 95% of you took full advantage of the volatility in the markets last year and chose to take the opportunity to rebalance your portfolio and or practice tax loss harvesting. So again, most of you have seen this. I'll do it very quickly, but you'll remember the red line represents your bond portfolio, while the colored lines represent your equities. In mid-March, we were busy rebalancing portfolios by selling your bonds and buying equities when they were almost 35% off their highs. By doing this, you were able to add extra fuel to your fire as equities came roaring back throughout the year. In regards to tax loss harvesting, also in that same time frame in mid-March, we performed an accounting trick called tax loss harvesting. For example, we sold equity positions here in mid-March when they were down off their highs, thus selling at a loss. Then the same day we bought a like position, so your portfolio still had that same exposure. 30 days later, we would rebuy the original position, locking in your losses. These losses you can now carry forward on your taxes, never to expire, and you can use them against any capital gains you have in the future. So in conclusion, 2020 was a very hard year for most, but in regards to your investment portfolio, it was an incredible year. Throughout the year, you were not only able to take advantage of above average market returns, but you were also able to take advantage of a market decline by practicing tax loss harvesting and rebalancing. Rarely a situation that happens all in one year. With that, I'll turn it back over to Mike, and he can discuss some invaluable lessons we can take away from markets last year.
So Katie highlighted for you the large disconnect we had in 2020 between the economy, unemployment, and rising asset prices, be it in equities or real estate. I wanted to take a minute to use 2020 as an example to highlight how the market and the economy become dislocated in the short term during significant market downturns. Historically, we see equity market declines of 30% or more only about once a decade. Given how infrequent they occur, we've noticed that investors tend to forget the lessons we learned when we go through them. So in 2020, the S&P 500 index bottomed on March 23rd, having declined off of its peak by about 35%. We actually didn't get our first negative jobless claim announcement until 3 days after the market bottomed on March 26th. Again, unemployment continued to rise rapidly through the spring and the summer. Also, after the market bottomed, later in the spring, the economy contracted substantially with the largest decline in consumer spending in history. Similar to 2009, we got our first sign of economic improvement in October of 2020 with the first announcement of positive GDP growth, at which point the market had rallied a full 54% off its bottom earlier in the spring. There are so many similarities here between both 2009 and 2020. And the important takeaway is that during major market corrections, the market doesn't care what's happening today. The market is looking forward and forecasting future expected profits. The market knows that it's bad today, and it knows it's highly likely to get worse in the very near term. And in fact, that negative sentiment has already been priced into the market. The market will price in the pain before the majority of the pain is felt. And at the same time, if we wait for things to feel better again, the market will have priced better days long before they actually happen. In the end, this is why disciplined rebalancing is so hard. Katie mentioned the difficulty of doing that rebalancing back in March. It's an emotional period of time, and you have to be willing to sell an asset that's outperformed everything else in your portfolio to buy the very assets that have performed the worst. So kudos to our clients for being willing to do this. And again, we just want to reinforce to you this disconnection that happens between the market and the economy in the short term during these major market declines. I mentioned rebalancing during significant market correction. Now let's talk about what we learned in 2020 about the important role that bonds play in your portfolio.
Thanks, Mike. So as we witnessed last year, bonds can have a huge added benefit for your portfolio and shouldn't be looked at as stock's sleepy cousin. Of course, you don't own them to maximize the gains in your portfolio, but you do own them to optimize the volatility in your portfolio. So let's review a few strategies to better understand why owning bonds in your portfolio can and will benefit you in the long run. First, they create stability in your portfolio. Let's look at last year and use it as an example. Let's say you have a $1 million portfolio, and let's say you had it all in US stocks. If you rolled out of bed and checked your portfolio on March 23rd, your $1 million would have looked more like $600,000 at the market bottom. That's a huge drop. If you can't stomach that type of volatility, or if your financial plan doesn't have the capacity to withstand that type of volatility, you should have bonds in your portfolio. Bonds won't be the sail to your sailboat. That's equity's job, but they will be the ballast, counteracting the rocky waters and volatility of equity markets. Second, they allow for rebalancing opportunity. Let's use that same $1 million portfolio and last year as an example. As discussed earlier, bonds provide an excellent opportunity to take advantage of equities on sale. If we go back to the same graph showing last year's performance, you'll remember the red line again represents the performance of bonds, colors show equity markets. If your $1 million portfolio was invested in a 70-30 asset allocation, you would have approximately $300,000 set aside, safe from equity volatility and basically flat on the year. $300,000. Then, as equities slid down to their 35% discount, you have that $300,000 to tap into to buy equities that are technically now on sale. And lastly, they provide a source of cash to use during equity market declines. Humor me, and let's go back to that same $1 million portfolio example one more time. Let's say you're taking monthly or quarterly withdrawals from your portfolio. And let's say you were ready to do that in April of last year, because you're depending on your portfolio to fund your living expenses. And if you only held equities in your portfolio, you'd be forced to sell those equities at a loss. However, if you had that $1 million portfolio in a 70-30 asset allocation, you'd have approximately $300,000 of bonds to live off of before you had to tap into your equity portfolio, thus allowing time for those equities to rebound from their lows. So in conclusion, last year was a great reminder why we own bonds in a portfolio. They allow us peace of mind, flexibility to rebalance, and opportunities to be strategic if need be in market declines. Joe, now on to you to cover the lessons of individuals and market timing.
Thanks, Katie. So another great learning point for 2020 is looking what investors did in regards to cash. This chart shows the returns of the global equity market from January 2020 to September 2020. The teal color line you see here shows the money market fund flows, which is essentially cash. If you follow that teal color line, you see that money market inflows peaked after the first quarter when the market bottomed, right up here, which was the worst time to go to cash. This would have been the best time to buy equities, which is exactly what we did back in March when we rebalanced our clients' portfolios. So really, I guess we should thank those investors because we needed them to sell in order to buy those equities in March. If you continue to follow that teal line through the end of Q3, you see that many of those same investors that went to cash were still sitting in cash as the market continued to rise through that same time period. Another great lesson of trying to time when to get out of the market, and even more so when to get back in. Let's do a quick check-in. Mike, do we have any questions?
Let me just check here real quickly, Joanna. I noticed some folks in the chat bar. Again, if you'd like to ask questions, please feel free to add them into the chat bar in the software. Katie, have you got one?
Yeah, I have one that came in. The question was, from the rebalancing, what was the benefit to me, or what did I see as far as difference in returns? And I can answer that. It's a hard question to answer, but just because our portfolios are managed from person to person, and so that answer is going to vary from person to person. So it's kind of hard to quantify on an overall aggregate level. But according to our math, we could figure anywhere between 1.5% and 3.5% you would have seen in additional gains last year because of your rebalance.
Great, thanks, Katie, and thank you for your questions. Again, just feel free to type them into the chat box. So now let's talk about GameStop. Doug Longo talked earlier today about trading flexibility and the big advantage it gives dimensional fund advisors versus index funds. We thought we'd highlight the importance of trading flexibility using GameStop stock as an example. So I'm going to assume that you know a little bit about the background on GameStop. This was the stock that was talked about every night on the evening news during the month of January, as a group of small individual investors in an online chat room decided to buy the shares of the stock that was heavily shorted by large Wall Street hedge funds in hopes that they could drive the share price up. You can see here, looking at the share price of GameStop, sort of year to date from January 1st to February 15th, that they were very successful in doing that, pushing the price of this thinly traded small cap company from $10 to $35 a share in just 2 weeks period of time. You can then see that it's declined back to about $50 a share, roughly where it sits today. So what's the lesson here in GameStop, and how did our small cap equity funds handle it? Well, first of all, GameStop began the year as a small cap value stock. As you can see in the previous chart, in just a matter of days, it grew to become a large cap stock, which made it become a much larger weighting in market cap weighted index funds. So let's look at what actually happened here with GameStop. If you look at it on December 31st of 2020, in the DFA US small cap portfolio, it represented just 0.05% weighting in the portfolio, which compared to just 0.04% for its index. Because it was a value stock, you'll see it had a little higher weighting in the US small cap value portfolio as it did in the value index. If you go out just a month later to January 31st, you'll see that once the stock on January 31st was trading above $300 a share, it represented a 0% holding in both the small cap and the small cap value portfolio. But in the indexes, it had ballooned in its weighting in the indexes to anywhere between 0.75% to 1.5% weighting in the indexes. So the real question is, in a disciplined rules-based investment strategy, right? Why did DFA sell? And why in their small cap funds during the month did they sell the stock? Well, as Doug mentioned with respect to the bond fund, they have very similar daily processes on the equity side for evaluating stocks that allowed for real-time changes in both share price and intended asset class construction of the portfolios. So as GameStop stock, say that 3 times fast, as GameStop's stock rapidly appreciated in value in just days, it became a large cap holding, which the small cap funds, which were then totally rules based, sold because it had become much larger in market capitalization than a small cap fund would own. And at the same time, the index funds must wait until their next reconstitution date to make changes to their holding. So the index funds rode the stock price up. And then those investors that added money to the index funds in that couple of week time actually added money in a disproportionate fashion to GameStop stock before it then declined in value. So what this example sort of highlights for you, and again, it's sort of dovetailing on what Doug said on the bond fund side, is that you can regularly use new information about expected returns using market prices in a flexible way to maintain exposures to security with higher expected returns. We know over the long term, small cap stocks have higher expected returns than large cap stocks. And this allowed them to sell the stock as it became a large cap stock. So I know I went through that quickly. If you have any further questions for us, please feel free to follow up with us.
Okay, so now let's take a look at, we've got a new government in place and what should we expect? So with Democrats taking control of the government, should investors be relieved or worried? Well, let's take a look here. Here's the growth of $1 in the S&P 500, and it's showing the party control of Congress since 1926. Here you can see some long stretches of when the Democrats had control of Congress in the solid blue line, right about here, and then you also see when the Republicans had control of Congress in the solid red. The data here doesn't suggest that a Democratic or Republican control of Congress leads to better market performance. Instead, you see that market rewards long-term investors before and after elections. So what trends have we seen when there's a unified control of government? And by unified control government, we are talking about when one party controls the White House, the Senate, and the House. So I like to share with you this slide here. I'd like for you to take a few seconds here and try to guess the average annual return of the S&P 500 from 1926 to December of 2019. And so you see here, during that time frame, 13 years the Republicans had unified control compared to the 34 years the Democrats had unified control. So let's see if anyone guessed correctly. Anyone surprised here? When I saw this, I certainly was surprised to see the exact same average annual return to the 100%. The lesson here is that markets do a really good job of incorporating expectations about political events before they happen. At the end of the day, markets are driven by companies and their earnings and profits. So moving on, I also wanted to share some financial planning reminders here in this slide. IRA required minimum distributions are back to normal for 2021. If you recall, they were suspended for 2020, but they are now back in play. With the Secure Act passing at the end of 2019, the RMD age was bumped up from 70.5 to age 72. If you are required to take a distribution, your advisory team will notify you before the end of the year. Another big change was the removal of stretch distributions from inherited IRAs. If you inherited an IRA from an owner who passed after December 31st of 2019, you will have to take all the distributions from the IRA within 10 years. Another quick reminder, if you are 70.5 years of age, you are eligible to make charitable distributions directly from your IRA. The distribution can be counted against your RMD amount, and it reduces your taxable income if taken directly from the IRA account and made payable to the charitable organization. If you have any questions about any of these financial planning reminders, please don't hesitate to reach out.
Great. Thanks, Joe. Okay, I get to tell you the great news. I always like and always request to have this slide so I can give you fun news about your DFA fees going down. So DFA is reducing their fees again, which means more of your money stays with you. So as you can see really here, really quick here, your equity positions are on the left side. DFEOX is your large cap holding. It's got a reduction of 14%. DFSVX, your small cap, a reduction of 25%. DFIEX, your international holding, is down 17%. DFCEX, your emerging market holding, is down 21%. And DFGEX is down 17%, and that's your real estate holding. So all of your equities are seeing a reduction in fees, so we think DFA to that. Okay, Rachel, do you want to go through the client portal really quick for us?
Yes, thank you, Katie. So as most of you probably know, we have launched our new client portal as of last month. And through the client portal, you will be able to view up-to-date account balances, holdings, and performance, as well as access year-end tax information, TD Ameritrade statements, and TD tax forms. This also will serve as your new secured document vault, where we can safely exchange sensitive information with one another. So this is a sample of what your portal homepage will look like. And if you haven't had the chance to set up your portal login yet, we will be sending out a reminder and new link tomorrow, Tuesday the 22nd. I did want to take this opportunity to remind you about the tutorial library on our website. If you go to the resources tab on our homepage, you will be able to access our tutorial library. There are tutorials for the 3 different platforms you have access to through Aspen Capital. So there's your financial plan, which is details about the financial plan you've built out with Aspen Capital. TD Ameritrade, which is where you can view account details and make money transfers. And then the client portal, which is where you can access virtually everything else. I also wanted to note that we will have our mobile app for the client portal coming in March. So stay on the lookout for that.
Great. Thank you, Rachel. And thanks for all the great work you've done in the transition of the software over the last year. If you haven't had a chance yet to log into your new portal, I would encourage you to do it. Lastly, I just wanted to give you a real quick update on the Schwab and TD Ameritrade merger. The big takeaway is there's no news there. We're about 2 years off from what we think will be the integration. So really, there is no news for us to give. It's business as usual for both you on the client side as us on the advisory side for what we think will probably be about 2 more years. So with that, I'm going to check and see if we have any more questions. And as I do that, I do want to remind you, we'd love your feedback on topics you'd like to hear more about from us in the future. If there's items that you'd like for us to cover in future webinars, please feel free to shoot us an email and we'll certainly put it into consideration. And then I would also let you know we are planning a couple of new webinars for this coming year, one on sustainable investing. That for some of you might have a lot of interest there, and then another one on global real estate and some of the misperceptions we think people have about real estate. Rachel, there's a question here. Will the financial plan eventually show up in the client portal?
That is a great question. So there are 2 aspects of the financial plan that you're able to view in the portal. You're able to view the net worth section of your financial plan based on the information that we've inputted during reviews with you. And then you also are able to view the success dial for your percentage of success based on the Monte Carlo simulations that we run for your financial plan. So that information is available in the portal.
Yeah, just finally to let you know, after this, we are recording this. If you've got friends or family that you think would enjoy the content, we'll be posting a recorded version of this to our website coming up in the next few days. We'll send a message out letting you know that it's there. If you'd like a copy of today's slides, please feel free to email anybody on our team, and we'll be happy to get you a copy of the slides from today as well. A couple of last questions here. Can you access Schwab funds now? Yeah, absolutely. I mean, TD Ameritrade, we can access virtually any funds from any asset manager at TD Ameritrade. So we're certainly not limited in that way at all. So with that, looks like we've answered all the questions. Again, thank you very much. If you'd like to follow us, you're welcome to follow us on social media. You can either like us on Facebook or on LinkedIn if you'd like to follow news that we're sharing from time to time. But thanks again for joining us today. Have a great afternoon.